In 1949, an investor named Benjamin Graham published a book called The Intelligent Investor. More than 75 years later, Warren Buffett still calls it the best book on investing ever written. That endorsement carries unusual weight. Buffett has spent more than 7 decades studying businesses, analyzing markets, and building the most admired investment record in history. He is widely regarded as the greatest investor of all time. Yet when asked what investors should read, he repeatedly points back to Graham's book. But why exactly does Buffett continue to recommend a book written long before the internet age? And why do investors still read it? What did Graham understand about investing that still matters today? In this video, we'll break down the core principles of the intelligent investor and see why its lessons continue to endure. Benjamin Graham was born in London in 1894 and immigrated to New York with his family as a child. After his father's death, the family experienced severe financial hardship, an experience that would later shape Graham's views on risk and investing. A gifted student, Graham entered Columbia University at age 16 and graduated 3.5 years later at age 20. He then began his career on Wall Street during the years leading up to the Great Depression, witnessing firsthand both the excesses of the 1920s and the devastation that followed the stock market crash of 1929. For many investors, the crash was simply a financial disaster. For Graham, it became a lesson. Markets could be wildly optimistic, then suddenly irrationally pessimistic. Prices could rise far above reality and then collapse far below it. Rather than abandoning investing, Graham set out to develop a disciplined method for navigating these cycles. His goal was not to predict market movements, it was to determine what a business was actually worth and invest accordingly. The result was the foundation of what would become known as value investing. Through his writing, teaching, and investment partnerships, Graham influenced an entire generation of investors. But among all of his students, one would carry those ideas further than anyone else. The Intelligent Investor was published in 1949. One of its early readers was Warren Buffett, who credits the book for transforming the way he thought about investing. At the time, Buffett was already fascinated by business and investing. He had read financial publications, studied stock prices, and experimented with investments of his own. But Graham's book gave him something he had not yet found: a coherent philosophy. The book argued that successful investing was not about predicting the economy, following market trends, or chasing the latest opportunity. It was about understanding the relationship between price and value. Buffett later described reading the book as an intellectual revelation. So impressed was he by Graham's ideas that he enrolled at Columbia University specifically to study under him. After graduation, he went to work for Graham, learning directly from the man whose ideas had transformed the way he thought about investing. The lessons Buffett learned would become the foundation of one of the most successful investing careers in history. Before Graham could teach investors how to value businesses, he believed they first needed to understand a more fundamental distinction: the difference between investing and speculating. To many people, the two appear identical. Both involve buying stocks. Both seek profits. Both operate in the same financial markets. Graham disagreed. He argued that investing is based on careful analysis. An investor studies a business, evaluates its financial condition, and seeks a reasonable return while protecting against permanent loss of capital. Speculation is different. Speculators focus primarily on future price movements. They attempt to predict what a stock will do next week, next month, or next year. Their decisions often depend more on market expectations than on the underlying value of the business itself. Importantly, Graham did not condemn speculation. He understood that speculation would always exist in financial markets. His warning was simpler. Know when you are speculating. Many investors get into trouble not because they speculate, but because they mistake speculation for investing. They convince themselves they are making rational investment decisions when they are really making bets on future price movements. For Graham, investing began with a simple idea. A stock is not a lottery ticket. It is ownership in a real business. At first glance, intrinsic value sounds complicated, but the concept is actually quite simple. A stock is not merely a ticker symbol moving across a screen. It represents ownership in a real business. Imagine you own a small hardware store. After reviewing its earnings, assets, and future prospects, you determine the business is worth approximately $100,000. Now imagine someone offers to buy it for $60,000. The next day, a different person returns and offers $150,000. Has the business changed? Has it suddenly become more profitable overnight? Has the building expanded or sales increased? Of course not. The value of the business remained the same. Only the offered price has changed. Graham argued that investors should think the same way about stocks. The market constantly offers prices, but those prices are not always reasonable. Sometimes stocks trade below their true value. Sometimes they trade above it. The intelligent investor's job is to estimate what a business is actually worth and compare that value to the price being offered by the market. That difference between price and value lies at the heart of value investing. But Graham understood that even the best analysis can be wrong. Businesses can encounter unexpected competition. Economic conditions can change. Investors can make mistakes. For that reason, Graham introduced what may be the most important concept in the entire book: the margin of safety. Imagine an engineer designs a bridge expected to carry 10 tons of weight. No responsible engineer would build a bridge capable of supporting exactly 10 tons. Instead, the bridge might be designed to support 20 tons. That extra capacity provides protection when conditions are less than ideal. Investing works much the same way. If you estimate a business is worth $100 per share, Graham would not recommend paying $100 for it. He would want a meaningful discount. That discount creates a buffer against errors in analysis, unexpected events, and simple uncertainty about the future. The margin of safety does not eliminate risk. It helps investors survive their mistakes. Perhaps the most famous idea in The Intelligent Investor is a character Graham called Mr. Market. Imagine you own a business with a partner named Mr. Market. Every day, Mr. Market appears at your door and offers either to buy your share of the business or sell you his share. The problem is that Mr. Market is emotionally unstable. Some days he is wildly optimistic. He believes the future is bright and offers an extremely high price. Other days, he becomes pessimistic and fearful. He assumes disaster is around the corner and offers a very low price. Importantly, you are never required to accept his offer. You can ignore him completely. You can wait until his prices become attractive. You can take advantage of his emotional swings without participating in them. This was Graham's insight. The market exists to serve investors, not instruct them. Its daily price quotations are opportunities, not commands. The investor's job is not to follow Mr. Market's moods. The investor's job is to benefit from them. As influential as Graham's ideas were, Warren Buffett did not spend his entire career investing exactly as Graham did. Graham often focused on statistically cheap companies. These were businesses trading at unusually low valuations based on assets, earnings, or book value. Buffett later described many of these investments as cigar butts. Like a discarded cigar on the sidewalk, they might have only 1 or 2 puffs left, but those remaining puffs could still be obtained at a bargain price. Early in his career, Buffett used this approach successfully. Over time, however, another influence began to shape his thinking: Charlie Munger. Munger argued that investors should focus not only on price, but also on business quality. A mediocre business purchased at a steep discount might generate a respectable return, but an exceptional business could continue creating value for decades. This led Buffett toward one of his most famous observations: it is far better to buy a wonderful company at a fair price than a fair company at a wonderful price. Companies such as Coca-Cola and American Express became examples of this philosophy. These businesses possess strong brands, loyal customers, and durable competitive advantages that competitors struggled to replicate. Buffett was no longer searching only for cheap stocks. He was searching for outstanding businesses. Yet Buffett never abandoned Graham's principles. He still cared deeply about intrinsic value. He still demanded a margin of safety. He still viewed the market through the lens of Mr. Market. Rather than replacing Graham's ideas, Buffett built upon them. More than 75 years have passed since The Intelligent Investor was first published. Markets and technology have both changed dramatically. Human psychology has not. The dot-com bubble of the late 1990s demonstrated how quickly optimism can turn into speculation. The housing boom preceding the financial crisis showed how easily investors can convince themselves that prices only move in one direction. More recently, meme stocks, cryptocurrency mania, and waves of enthusiasm surrounding artificial intelligence have revealed the same emotional patterns Graham observed decades ago. The details change. The psychology remains remarkably consistent. That is why one of the book's most important lessons, Mr. Market, has little to do with accounting, finance, or stock analysis. The greatest challenge facing investors is behavior. Benjamin Graham gave investors a framework for thinking rationally about markets. The ability to remain rational when others become fearful. The ability to remain disciplined when others become greedy. The ability to distinguish price from value when emotions begin to dominate decision-making. The intelligent investor remains relevant because it teaches investors how to navigate these forces rather than be controlled by them. You can't control what the market does tomorrow, but you can control how you react to it.
Thank you for watching. Please like and subscribe, and click the bell to receive notifications for future videos. Also, please consider supporting the channel on Patreon. Support for the channel helps improve quality and makes future videos possible. Thank you.